is one thing though that is a bit more heavily in the negative area of it. It's a CBDC topic where it say that's a threat to freedom, as you would say it, if I'm repeating. Why do you think so? What is if someone has not heard about CBDC yet, what would you say is it, and what's the danger behind it?
Yeah. I'll answer that by explaining really quickly what the different forms of money. So we've got, number one, we've got commodity money, and that's like thousands of years in the past. People had gold and silver coins, or sometimes seashells, or sometimes cows, or sometimes lambs, or sometimes rice. You had a commodity that operated as money. So when people engaged in transactions, a physical commodity would actually exchange hands. Now that's great from this, especially something like gold. That works really well for the most part because it's a very limited supply. It's hard to create more of it. It lasts forever. It won't decay on you, and it's hard to forge or fraudulently, like counterfeit it. And so there's a lot of great characteristics about something like gold being money that caused it to be the dominant form of money for so many thousands of years. There's a negative side to it, though, and that's that it's hard to transact across large amounts of space. So it's good for like small local economies. But if I wanted to, buy something from China and I'm living in the United States, let's say, 500 years ago, if I was, a Native American and wanted to sail across the sea to buy something from China, well, that'd be really difficult because I would have to actually put gold on a boat and ship it over there. And what if the boat gets, shipwrecked, or what if there's pirates or something like that? So it's very costly to transact across a large distance with a commodity. And so the invention that eventually became commonplace was a commodity-backed money system. And that's where you, instead of the commodity itself changing hands, you have ownership of that commodity changing hands. The commodity stays in the same place, though. And so that's what a bank was. A bank just took all of the gold and held it. And then you have a piece of paper that says you own that gold. And when you want to buy something, you change that paper moves hands. So all that's happening is the ownership of that gold is changing hands. And so what that allows you to do is it allows you to have transactions across larger distances for a much lower price because, number one, paper weighs less than gold does. Number two, all you have to do is confirm that ownership of that gold has changed hands. And the more you centralize that and scale that up, the larger the distances you can transact. And that's why the central bank in the United States allowed much greater commerce to happen across the state boundaries, instead of having, each state has its own money and businesses have to worry about, the differences in the banking systems and rules from state to state. You centralize that so it makes commerce easier across.
A bit like what the EU does for the European market, where it's like a bit more newer, but the same idea. Many different players who say, okay, you know what, we're going to do one currency, we're going to do one thing that we can share and we all accept as payment from now on. So it's easier for the markets to interact with one another. We in Europe, until a few years, it's now already decades, but it was like, if you go from Austria to Germany and then further to Sweden, and so you had to change your currency 3-4 times in the time span of sometimes 2 or 3 days, and each time it cost money, and each time it was bothersome. But sorry, yeah.
No, you're exactly right. It's exactly the same idea there on the benefits that it brings. And you bring up a good point, actually, because whenever we're discussing, changes or things happening in economics, there's always a trade-off. So yes, there are good things about it, and there are winners as a result. And one of those winners might be large corporations that have the ability to grow easily across state lines now. And one of the losers might be the small mom and pop shop that can't compete now because a big corporation moved in down the street, that they wouldn't have been able to do that because of the lack of efficiency with, the different forms of money before. And so there's always a trade-off. There's always winners and losers. There's no such thing as like perfect for everybody. You always have to ask what's the cost, basically.
Yeah, we had that in Europe, for example, a few years ago with the financial crisis in Greece. where it was like usually an economy that's in a bad situation can get out of it by inflation. Not just inflation, but also by their value losing worth in exchange for other currencies. So the market usually has a bit of an advantage in exporting their goods to other markets because their work, labor, and resources are cheaper. Now in the EU, the problem was because the currency is tied together with strong economies, they couldn't use all of these techniques that are usually for small economies that are a bit of in a slump. So it was, as you say, it's a trade-off. It's good, but also bad. It's always an interesting. So the EU had a bit of a stressful time with that, and the Greeks had a lot of issues back then because they weren't able. There was discussions about a small euro extra just for the weaker nations, weak economies. But just wanted to point out that also nowadays, even we still have the same issues with the trade-offs. And it's a good thing to have the debate of, okay, if we do something, what is the trade-off? Okay, you want to buy it, you want to sell it, you're going to tell me the good thing, but what is the bad thing about it? There's always two sides of the coin. So to have an elaborate discussion, it's always important to shine light on both sides. I'm absolutely on your side with that.
Yeah, exactly. There's always a trade-off. So those were the two monetary systems. The first one for thousands of years, and then over the last hundreds of years, the commodity-backed money systems kind of evolved. And then in 1971, when Nixon closed the gold window, thrust the entire world out of a commodity-backed monetary system into a fiat system. And so what most people don't understand about the current fiat monetary system is that it is a ledger monetary system. So there are two types of ledgers. There are private ledgers and there are public ledgers. Many people are familiar with Bitcoin, but the technological complexities make it a little bit intimidating for some people. So the only thing that most people need to understand about Bitcoin is that it's an Excel spreadsheet. And imagine in the first column, you have a list of all the account numbers. And then in the second column, you have a list of all the money in each of those accounts. And then you have a list of all the transactions that took place in all the accounts, all the way back to the very first transaction. And that's all Bitcoin is. And that spreadsheet is accessible by anybody who wants to access it. And because there are so many people or computers looking at the spreadsheet, if anybody goes in and tries to make a change to it, everybody will recognize, hey, that change happened. Like, so we know that's not real. So we all have a copy of the real one. And so because it's such a large network of so many people looking at that spreadsheet, it's difficult to impossible to kind of break it. And that's all it is. It's literally just a list of numbers. And now people look at that and say, well, I'm going to look at the amount of Bitcoin that I have as money. And so if I want to have Bitcoin in my Bitcoin account, then I have to do something to convince somebody else to give me some of that Bitcoin. So commonly, what I will do is I'll give them dollars or I'll give them euros and they'll give me some of their Bitcoin. And then that transaction will be recorded on that public spreadsheet forever. But I don't have to give them dollars or euros for it. I could give them a pizza for it. I could give them 8 hours of labor for it. I could give them anything. And as long as they agree, I give them something, they give me the Bitcoin in return, then that transaction happens when they send the Bitcoin. So that's all a ledger is. It's just a list of accounts with the amount of money in each of those accounts and the transactions. And Bitcoin is a public ledger. So that's, that's what it means that, everybody can see it basically. And the rules governing when money is sent, when money is not sent, if transactions could be changed or anything, that's public as well. So that's basically the entire network decides those rules, and the way that Bitcoin's rules are set out are publicly known, and that basically if money is going to go from one account to another, it's got to be initiated by the person who has the money to send, the Bitcoin to send. Today's regular monetary system, like banks, this is also a ledger system. It's a private ledger system, though. And so every bank has an Excel spreadsheet that has a list of all the account numbers at that bank, the names associated with each account number, their birthdays, their government IDs, and all that. the amount of money in each of those accounts, and then all the transactions that took place in those accounts. That's all a ledger is, and that's all a bank is, because we don't have anything backing it up anymore. There's no redemptions to be made. There's no claim on a commodity. It's just a list. And then when money gets sent from one bank to another, those two banks go to each other and they say, okay, I'm going to send you $100. So I'm going to subtract $100 from, my money. You're going to add $100 to yours, and we make sure that they're accurate with each other. And then, we call it a day. So the monetary system we have today is a decentralized, private ledger monetary system. A bunch of different banks maintaining their own ledgers, and only those banks can control their own ledgers. So right now in the United States, there are some issues over the last couple of years with certain types of businesses getting shut down by their banks, their bank accounts getting shut down. So businesses that sell firearms, businesses that sell marijuana, businesses that sell gold or silver coins.
Just let me ask you, just give me, for all the views from Europe who don't know about the American situation, are we talking, or the legal situation, are these illegal businesses? So it's like, okay, no, you did the crime and we're gonna freeze the bank account because you did crimes, or were those legal businesses where you say, hey man, we were legal, we followed all rules, and we still got shut down or frozen accounts suddenly?
Great. That's a great question. And I'm glad you made that distinction. These are all 100% legal. So there's no criminal activity going on. These are, registered businesses. They're real businesses. They're following the law. They pay their taxes and all that. But there are certain businesses that have, different, stigmas, or, the banks are private companies. And so banks may not want to do business with other companies that are engaging in certain business activities. I was just going to bring that up.
Now we don't want to have to do with sexual things or this and that. And America is a bit on the more prude side compared to, like, let's say, Europe. So the values a bank has, or many companies have, they're like, we can't risk doing stuff like that. We can't risk it for our public image. But I didn't know that they could just like cancel the accounts. I thought it would be like protected by law or something like that.
Yeah, so the money, it's not like they're stealing the money, but they issue a notice to the business and say, we're going to close your account. You have 30 days to withdraw your funds and go somewhere else. And so there's a that is an issue, but there are usually other banks that will take that business. And so there usually is somewhere else for them to go. So in our current system, we've got this decentralized or distributed ledger system that is a bunch of different private ledgers, and the banks can shut down transactions. They can pull back transactions. They can control those ledgers. Now, some of the problems with this are that settlement times take a really long time. It's very difficult and costly and slow to send money across state borders, across national borders. It's very difficult to do business if you're one of those kind of businesses that I mentioned, because you've got issues with the banks maybe not wanting to do business with you. So you've got a bunch of little issues popping up. And then right now we're experiencing the issue of banks not being stable enough. And so the way that banks make money is they take your dollar and then they go and they buy an asset with it. And so that dollar is not actually there. Or most of those dollars are not there. And so if everybody tries to get their money out of the bank at the same time, the bank is forced to sell all the assets that they bought. And right now, across the world, basically every asset that almost every bank owns is worth less than when they bought it. And so any bank that gets a run on the bank would be forced to shut down because they wouldn't have enough to meet all those redemptions. And this is an issue. This is a layer that's left over from old monetary systems when money was backed by commodities that needed redemption, and you have private businesses trying to make money with that. And so we do have a lot of issues. I'll stop there because it looked like you were going to make a note.
Yeah, I was just to point it out. It's not a momentary issue right now, because we've had like the the interest rates of the central banks and other issues like the supply chain issues, and so it's not that. The issue is it's built into the system that all banks always are technically bankrupt because they owe more money than they have, because they give the money that they have. Well, if you have 10 depositors, the bank gets the money of all of them, and they will take that money and do something with it, and they will loan out more money, not one-to-one, but they will loan out more money than they have ever gotten. That's an important thing for the viewers to know. It's not like, okay, we're in a, it's like called in the news the credit crunch, or it's something that will always be built into the system in the way it is built right now. That a bank always has the issue that if all people go and want to get their money, that it's impossible that all of them get it. That's just a technicality that is right now. So it's built into the system. Just wanted the people to know about that, so they don't think it's like, okay, right now some issue.
Right. Yes. And so the only time that it doesn't feel like an issue is when those assets are still worth, full price. Because then if they had to sell all those assets, then they could most likely get, enough to be able to meet the redemptions. But then at that point, they have no more money. So they go under. The depositors get their money, but they go under because they've got nothing left. And so, yes, there's, it's the way that banks operate. It's the foundational system that is broken. And so I'll enter into the discussion a central bank digital currency and how it fixes a lot of these issues before I talk about how dangerous they are. So a central bank digital currency does very simply one thing. It just makes one ledger for the money instead of a bunch of different ledgers at a bunch of different banks. That's it. And it makes that ledger with the central bank. So like right now, when you go to the grocery store, you swipe your card, you send money from your bank account, which is with money's at one bank, and it goes to another bank, account that's held at a different bank. So banks are constantly sending money back and forth. There's settlement issues. There's issues where you say, hey, no, they took too much money. Like, this is fraud, and they don't have the records. And that's why there's a lot of these slow issues, costly issues, settlement across state lines, things like that. So a central bank digital currency, because they put it all onto one ledger, the central bank doesn't have any of those issues. To move money from my account to your account, it's just a change on the Excel spreadsheet. So I can do that instantly. Guess what? I can do that for free. And since I have a record of every single transaction, because it's all on one spreadsheet, I can go back and I can see if an error was made, whether we sent too much money based on your request. I can instantly undo errors, things like that. And so because it's centralized all under one, it fixes the speed issue. It fixes the cost issue. It fixes some security issues with, employees at private banks having access to personal information about people. And the biggest one right now that people will probably care about is that it fixes the issue of bank insolvency, because no longer do you need to take dollars and then loan them out, create an asset in order to keep the bank rolling along for depositors. If you just have one Excel spreadsheet at the central bank is the one with the monopoly on creating the new money out of thin air. So in order to finance its own operations, all it does is it credits more money to its own account to finance its operations. And so it doesn't need to take your dollars and loan them out to create an asset. So your dollars will just stay there. Nothing's happening to them because there's nothing really there. It's just a line item on a spreadsheet. That's it. And so the problem of bank insolvency, of your dollars being loaned out over and over again, it goes away. Everybody could go and withdraw their money at the same time. But in order to do that, to take your money out, you have to spend it somewhere else. Like, you wouldn't be able to just go get it in cash And so you in order to take it from your account, it's got to go to somebody else's account. So it all stays at the central bank 100% of the time. 100% of the money is at the central bank. It's just switching which account it's in at the central bank. So you eliminate the risk of a bank run, you eliminate the risk of bank insolvency, and you eliminate all the speed and inefficiency issues. And so you do solve a lot of problems that our current system has, which is left over from all these older systems. So I'll stop there before we get into the dangers.
Okay, because a few of those things do sound like interesting and positive. Like, as you said, the security aspect, you can see years later who transacted what money to what other account. Like with cash, we don't know where that cash came from exactly and where was it before and before the owner of the one who had it right now. Everybody's going to talk about crime, about bribery, about all of these different aspects of money laundering, because that would technically, I think, not just technical, but it would be possible. It would be with, I think there's going to be some kind of twist where it's still working in some way, but it would be much, much, much harder. And every transaction would always be recorded and linked to the person who has that wallet or that line item or however they're going to call it. But as you said, the issue also is no cash. Of course, it doesn't work with cash because I can't take the money out of the ledger and then give it to someone else in cash, and the ledger wouldn't know that there was a transaction between me and that other person. All of the transactions have to be completely digital. Okay, that's interesting take, yeah. So, I mean, my spidey senses are already tingling. Like, there are a few things. Europe has a bit of a history with people who want to have a bit too much authority. Like we have had quite a few such examples over the centuries. If you like this clip, watch another one, and if you want to see the whole interview, click here.